Okay, in today's video, I'm going to be going over one of my primary option strategies that I have identified, and it's worked well for me so far, and I think it will continue to in the future, and I see some opportunities with it. So in today's video, I'm going to hop right into it. So this is a long-term call option strategy. Right now, since it's July 2021, I'm looking at January 2023 call options. So with this strategy, you want to look for the farthest expiries possible, and you want to look for basically smaller stocks you believe in that you think has some big growth potential, talking anywhere from 50 to 100% plus growth for the company itself over a short time period. We're looking at like a year plus. If you see some big sales, some big events, big moves coming. For example, I see Switch making some really big moves soon, and I really like the pricing of their options. So that kind of allowed me to do the strategy with it. Pretty simple. So let me get right into it. So in this scenario, Switch is trading at $21 right now at this given date at the time of the recording. So $21 a share, right? And I have a price target on it personally of 32. I think Switch will go to $32 a share at any point before January of 2023, right? So I'm calculating this where it'll go there at any point. Because it's an option, if it goes there a little bit sooner, I could make a little bit more with my premium. But I'm calculating it no theta, just straight value of the option at its expiring. So if Switch went from $21 to $32, right? And you did shares, right? So you might think, why not just trade shares? If you want to be safer, yes, trade shares. But if you want to be more aggressive, you could look at this call option strategy. So trade your shares, you go from 21 to $32, right? You make $11 per share. You make 52.38%. Not a bad return, right? However, if you do a call option, right, and you want to maybe put a little bit less money, where maybe, yes, you will lose all this money, but you're risking less because you're leveraged into position, because that's what a call option is. It represents 100 shares. So these were the three call options closest to the money since it was trading at 21 a share at the time of this recording. So I picked the 20 call option, the 20 strike. So I use this option specifically too because you can see there's big spreads in these options. So even if you have big spreads, it doesn't matter. If you believe in the company long term and you're calculating the option's core value, and we're looking at such low premiums like we are in this scenario, keep in mind, this is all the way for January 2023. And the premium on the $20 call is a middle price of only $3.60, right? Use the highest price. For the sake of the example, I used $4, a $4 premium, because it's pretty close to the ask, 4.1, because I was going to use the ask, but I figured for example's sake, it'd be even easier. So if you're looking at an ask price, right, 4.1, so you get the $20 call option for 4, right? So your break even now is 24 a share. You need Switch to go to 24 a share or higher by January of 2023 in order to profit on this call option, right? If the stock price is already at 21, you only need it to go up $3, 1/7 of the price upwards. I don't know the exact percentage of that off the top of my head, but only 1/7 of a price move, right? Just to break even. So that represents a smaller premium, right? There's not a lot of volatility expected in the stock. But if volatility picks up a little bit and momentum comes with the stock, I'm not even talking about in this particular video why I believe in the stock. This particular stock I do happen to believe in, but of course I'm not a financial advisor. So just talking about my option strategy in this video. So let's say Switch goes to 32 a share sometime in 2022. Doesn't even matter when, because we're calculating the core value of the option. If Switch goes to the $32 that we talked about, right? 32 a share minus your strike of 20, you'll get a final premium of 12. Your paid premium was 4, right? So now you profited a premium of 8. Times 100 shares, you profited $800. You put $400 into the trade, and then you walked away with $1,200. That represents a 200% return. So if you had just gone shares, you're only looking at a 52% return. If you're a little more risk averse and you can handle options and you believe in a company hitting a price target in a specific time frame, my opinion, the farther out the better, but not a financial advisor. you make 200%. 200% on a call option in this scenario and 52% on stocks. That's what it all comes down to. And in my opinion, you could do this with a lot of small companies. Again, not a financial advisor. You want to go figure out your own companies, figure out your own details with these companies and due diligence and things you believe in. And then if you can find a stock, you really believe in it, and then you look at some long-term options and you see premiums like this, in my opinion, huge opportunity to capitalize. You can capitalize massively with this because I see Switch, it's a data center company with a massive total addressable market in the coming years, and clean energy. They're a completely clean energy company, which I think is very unique to the fact they're such a large data center company with so many campuses and so much just space taken up. And the fact that they're being environmentally responsible, I think, is a good corporate look for the company while they're growing profits, expanding their name, their footprint, all of that. Hence why I'm playing the options. And this is just one specific example. There are several others. When you look at small companies, there's a lot of SPACs that are going public, and now when their ticker changes, a lot of selling after the hype phase of the SPAC. So then if you can get a suppressed price on some of these companies, because some of these companies are actually good. If you look into a good company, you find a suppressed price on a SPAC, you can trade a nice long-term option. There's some nice cheap long-term options on post-SPAC stocks. So that's all for today's video. I'm Noah from the Value Growth Index. Thank you so much for watching. Like, comment, subscribe.